Hello and welcome back to KD's Business Tips. Michael Lapede here talking to you about how to evaluate a possible business acquisition. In the last video we talked about the advantages and disadvantages of acquiring a business, and now we're going to talk about evaluating a possible business acquisition. And one of the biggest and important things is don't try to value it on your own. Bring in professionals. Bring in people that are valued in the area of valuing financial information, assets, a company itself. Very important that you bring in the professionals to provide you with what you need, including potentially a valuation report. An evaluation can be done by a licensed evaluator, and it can be done in various methods. There's a calculation report. It's the simplest. It's kind of a basic one, and the higher you get, the more expensive. The estimated report, which is the next one, much more mid-range level, and then the comprehensive report, the highest level of detail. They'll do lots of comparisons, all kinds of things. So there's different levels of valuation, but either way, it is good to have a valuation report to know that the company is valued by a professional at a certain value. Because at the end of the day, you want to pay below the value if you're buying it. That's the goal. You figure out the values and you're hopefully paying a little less. Now you want to gather the relevant business information you need to access. So financial, you need at least 2 years financial statements. You need at least 2 years of tax returns. You've got to have both, the corporate tax returns or whatever the tax returns are, and the last 2 years of financials. You want to make sure those match and they're reporting properly. You want, if you're buying the actual corporation, you want to value CRA accounts and see where, make sure they're up to date. You want to value assets, very important. What are the valuation of the actual assets that are on the books? They say you got tools and equipment. Let me see the tools and equipment, get a valuation on those, right? You're looking at value if there's liabilities, the staff, the team, the performance, all those types of things you want to look at. And if there's any agreements as well, if there's business premises, so there's lots of different things depending what's all coming with the business, but anything that's coming with the business, whether it's an asset liability, and it can be an intangible asset, like I said, like staff or other things, you want to value these things. And you can apply also a different valuation method to different businesses, but a lot of valuation methods are based on the balance sheet. So we have assets minus liabilities and the equity of the company, and then we usually add some net profits for the next 3 to 5 years. They call it EBITDA, earnings before interest, tax, depreciation, and so forth. So, that is typically a regular valuation method. Some will do a combination, but at the end of the day, the fair market value and what you're paying for has got to be what they could sell it for. I mean, if they can sell it to someone else for more, they're going to sell it to someone else for more. But if they can't sell it, then they're obviously probably priced too high if they've been listing on the market. It's kind of like real estate. If you leave it on the market, it's not selling. What are you going to do? You're going to lower the price to try to sell it. And it's kind of the same thing. You want to make sure you're not overpaying. So that's why a valuation is important, to know what is the true valuation. What is it worth today? Because what you want to do is you want to get it lower than the value today and then increase the value for the future, because that's where the true value is in the future of the company. Any questions? We'd love to hear from you. Post in the comments below and we'll see you back here soon.